Hello, everyone. This is Devin Thorpe for the CrowdFundBeat, and we are just beyond lucky and fortunate today to have with us the extraordinary, renowned super angel, David S. Gust, the CEO and founder of Gust. Did I just say that your name was David S. Gust?
Gust. That's
so
not a bad name.
It's David S. Rose, the CEO and founder of Gust. And apparently, I'm your easily confused host, Devin Thorpe. David is also the author of the best-selling book, Angel Investing. David, I apologize for mucking that up, but welcome to the show.
No problem, Devin. My pleasure.
It's great to have you here. So, David, there's so much to try and build a foundation for our discussion, but please start by explaining a little bit about Gust and what that is.
Sure. Gust is quite simply building the infrastructure platform for the whole future world of finance. And so what that means is if you are an early stage company that is going to grow into one of the future leaders of the world, you need funding, you need to connect with investors and supporters and stuff. And so we connect companies. We provide tools for companies to reach out and connect with investors. And if you're an investor, an angel investor, who is going to fund this next generation of global leaders, you've got to figure out where they are, you've got to work with them. So we provide tools for angel investors to work with companies. And so everybody else in the ecosystem as well, from angel investment groups to venture capital funds, accelerators, incubators, business plan competitions, all use Gust in varying ways to connect and collaborate with each other to the point where we now have over 250,000 companies around the world, over 50,000 accredited investors, over 1,000 venture funds and angel groups, all use Gust as this collaboration discovery platform and a tool set to make it all work.
Now, David, I believe there was a rebranding a few years ago to Gust. It was known by another name previously,
sure.
Wasn't it?
We originally started as AngelSoft because if you think about the challenge faced in creating this whole global platform, you have to start somewhere. And it turns out that if you have a platform that connects startup companies looking for funding and angel investors who are funding them, there are two different value propositions. One of which is stick your hand out and get free money, and that's pretty good. So entrepreneurs will find you no matter if you hide yourself under a bushel. On the other hand, for investors, the challenge is, okay, reach into your pocket, pull out money, and give it to this visionary entrepreneur. A little bit of a harder sell. So we figured to start with the hard side first, start with the angels. And so we began by working with angel groups and angel investors, providing the software and tool set they needed. And that's why it was AngelSoft. And then when we got to an appropriate critical mass, at that point it was about 30,000 or so accredited investors, angel investors. We then opened it up to entrepreneurs, rebranded to Gust for the whole larger ecosystem.
That's great. Well, I appreciate you sharing that history with us. And now you've written a book about angel investing. Tell us a little bit about your book.
Sure. It's called Angel Investing, the Gust Guide to Making Money and Having Fun Investing in Startups. And it's the first real instruction handbook on how to be an angel investor. We often think of angels as having been around since day one, and there certainly have been people funding companies for hundreds or thousands of years. But angel investing, as we know it today, is a very, very recent development. I mean, if it goes back to 1600 for the stock market, public stock markets, to the 1950s for venture capital, angel investors as we know them today really only had their debut 20 or so years ago, and it's been a very small world, limited to people generally with a lot of money who had their own independent deal flow and moved in those kinds of circles, and so it was sort of learned by doing. And there was no way, if you wanted to become an angel, how do you do it? Where do you go? The rise of angel groups, the Angel Capital Association, the Angel Resource Institute, all of those helped over the last few years, but there was still no simple book that said, okay, here's what you do. Here's how you find companies. Here's how you analyze deals. Here's how you handle the terms and negotiate it. Here's how you help companies after you invest. And so Wiley, one of the largest business book publishers in the world, decided there was a need for a book like that, so they approached me, asked if I'd write it. I said yes, and there you go.
Here we are. Well, that's wonderful. Now, let's just take a minute and make sure we're defining some terms for the audience, for some of whom this is all new. So how does an angel investor compare to a venture capitalist, for those who don't know?
Well, that's a good question. People often refer to them as one word with no spaces, angels and VCs, or VCs and angels. But in reality, there is a very, very key difference. A venture capitalist or a VC is a professional money manager. That's their job. They go out and raise a big fund of monies, anywhere from $50 million to $2 billion, enormous big pots of money from institutions that have a lot of cash lying around. Insurance companies, pension funds, university endowments, really, really rich people who write multi-million dollar checks. They take this fund and then they go and invest it in companies at a relatively early stage, hoping the company will grow very large and make a lot of money. And they get paid by taking a small piece of the funds under management every year as their salary and stuff. That's called a management fee, and then sharing 20% typically in the profits that they create over time. So they're a professional money manager of other people's money. Angel investors, in comparison, are individual people like you and me who invest ourselves out of our own pockets, our own money, into startup companies. And typically, because most angel investors are not writing multi-million dollar checks, they're writing multi-tens of thousands of dollars checks, they're investing at a much earlier stage when companies' valuations are much lower and you can have a real impact. So angels typically are the next step in funding after the entrepreneur puts in his or her own money, and then they get friends and family who are investing in them as people, effectively not in the business, to provide the next cash. And then the next stop is typically angel investors. And in the U.S., angel investors invest in something like 60, 70,000 companies every year. And so that's where most of these big companies that you see today making all the news started their funding.
Well, that's a great foundation so people understand. Now, I wonder if we could talk just a little bit, given our audience is focused on crowdfunding, how you see angel investors interacting with this expanding crowdfunding community. I'm most interested in the relationship between angel investors and the equity crowdfunding that is beginning to develop around the country.
Sure. So there are, as you know, there are, and as your listeners know, there are three kinds of crowdfunding. There's rewards-based or pre-purchase crowdfunding, the Indiegogos and Kickstarters of the world, which have been around for a while. And that's you buy a product or you get a reward for having put in your cash, but no equity. The interesting piece is the equity crowdfunding, where you're buying stock, shares of stock in a company. Now, today, according to the Jobs Act of 2012, there is only one kind of equity funding that is legal, and that is traditional funding by accredited investors. And so all the platforms today that are supporting funding, whether it's the Funders Club or Circle Up or AngelList or Gust or whatever, we're all dealing only with accredited investors. And so what we do is we take the process of being an angel investor, and that's what, you know, all angel investors are accredited investors, and make it easier and make discovery easier and make the process of finding and collaborating and investing easier. So that's what everybody does now. The interesting thing is the Title III component of the Jobs Act, which will allow for the very first time since the SEC was founded in people who are not accredited investors. And that means they don't have $1 million in net assets, they don't have incomes over $200,000 a year. It lets those people, the mass, the crowd, actually invest equity in companies. That's not legal yet because the SEC has been taking its good time to write the rules about this, and the current draft set of rules is probably too unwieldy to actually function. So it's not here yet, but likely something is going to come down the pike within the next, pick a number, 6 months to a year.
So how do you feel about crowdfunding? And I guess, first of all, let's talk about accredited investor crowdfunding. Are you seeing the talk about and the enthusiasm for crowdfunding expanding the pool of angel investors? Are you bringing in people who may not have experience in it, may not have as much money, but are tantalized by all this talk, and are they getting on Gust and participating?
Sure, absolutely. I mean, we're seeing thousands of people come on, you know, on a monthly, you know, basis. And that's why I wrote the book. That's why Wiley felt there was a need for the book. That's why it's a New York Times bestseller and a rather arcane topic of angel investing. There has been so much attention paid both to, you know, the companies like you know, Instagram and WhatsApp and Uber, and that have enormously insane valuations after only a few years on the one hand, and then the idea of these angels and people who were investing early making a lot of money on the other, so that it's now become something that even whether you have Shark Tank on television or it's gotten into the mainstream, and so a lot of people are really interested. That's why I wrote the book. That's why angel groups are growing rapidly. There are more of them. They're getting larger, and that's why there's a whole role for these equity funding platforms, which today are for accredited investors only, for effectively angel investors.
Let's look at the broader crowdfunding for what I like to call ordinary investors, the non-accredited investors. Based on what you've seen in the law, the Jobs Act, and the rules that were the draft rules that were circulated last fall, what's your take? Is this going to work for startup finance?
Realistically, I don't think the rules as currently promulgated, currently proposed, are going to work. They're just too unwieldy. And there's a very delicate balance here. And this is one of those things where everybody is sort of right in some way. And the SEC, state regulators, are very concerned about scams and fraud. And in reality, that has not been a big issue, certainly at all with angel investing, where there's virtually no fraud whatsoever. And even with traditional rewards-based crowdfunding, there has not been a lot of direct fraud per se. So that fear, I think, is overblown in a lot of quarters from people who aren't really familiar with what's happening. That being said, there is a really legitimate question about, if angel investors, if accredited angel investors who are experienced, who belong to angel groups, who have invested in dozens of companies, still half the time lose all their money. I mean, the average average person today who calls him or herself an angel investor has actually lost money instead of made money, and that's being an accredited investor with all the support and stuff that they get now, with the ability to negotiate and have leverage in negotiating deals and protective provisions. So now if you say, okay, we're going to take that and take the average person with no experience coming onto an online platform where they have no leverage, no negotiating power, where they're effectively going to throw in dollars and check a box saying, yes, I want to invest, the real question there is, what are people's odds of making money? It's certainly great for entrepreneurs because it's going to open up a whole new funding source for them. There is a real question, however, as to whether it will actually be a viable way to build assets and make money for the investors. And I think that we're all trying to figure out how best to make this work, because there's no question that crowdfunding from non-accredited investors is going to be an important part of the future.
Well, it is interesting to think about. I guess I tend to hope that the crowd will develop strategies collectively for finding value, and that it won't be quite the mega disaster that some naysayers expect.
Well, I hope Devin. I hope you're right. I'm not. The crowd has a tendency not to do things together. The crowd, it's like Adam Smith's invisible hand. Everybody does their own thing, and the result of that, at the end of the day, is something that works. And I think that the platforms that ultimately, at the end of the day, it's going to be the systems, platforms, companies, whatever structures that provide returns for investors. I mean, so if a platform has been out there and people keep losing money and losing money and losing money, they're not going to come back, and that platform is going to die. On the other hand, if you have a system where people demonstrably make money, then people are going to absolutely flood to it. And what's likely to happen is something that's going to be a little bit like Las Vegas, where you're going to have one big winner that's going to be a multi-million-dollar return, and nobody else is going to make money, but people are going to constantly try and put their cash in and hope for that. But we'll see how it plays out.
Yeah, it will certainly be interesting. How are you expecting the deficiencies in the Jobs Act / SEC regs that came out under the Title III rules, how are you seeing that getting fixed? It seems to me that it will be. I'm not sure of the path. What do you think the path is for getting fixed?
The bottom line is, I think there's almost universal agreement among everybody in the crowdfunding space that that the rules as promulgated don't work. Period. Right. The question is how much are they not going to work? And again, the general feeling seems to be they're really not going to work. It's just not viable, and it may not even be fixable. So what you might end up seeing is a whole new, either congressional something passed saying do this exactly the way we tell you, as opposed to some other way of doing it, or you might see a wholesale revision of the proposed rules. I'm pretty sure that the rules as currently proposed are not going to pass as is.
Yeah, it is interesting. I heard one rumor that was being discussed that seemed to me to be a great solution, and I'd be interested in your feedback. But the idea was to essentially allow for sort of unfettered crowdfunding with no specific requirements beyond compliance with fraud rules, so long as the investments, individual investments, are less than $2,500. What's your reaction to that kind of a notion of just it seems like almost a free-for-all, but it sort of requires faith in the crowd. What do you think?
Well, I mean, I felt pretty strongly that the original version of the Jobs Act, when it was still in the House, actually made a lot of sense. The Senate tried to do some good things, and they mucked it up by making it more and more complicated. Then the SEC came in and made it even more complicated. And I tend to agree that simplicity is absolutely the best. My guess is that something like that, a $2,500 cap per investment per company, combined with some type of overall cap, for the year, which was originally proposed as well, is probably the best way to do it. I don't think that because if you can only lose $2,500 in a particular thing, that knocks out the sort of scammers, right? Because there are a lot of other easier ways to scam people out of money than $2,500 at a time through a regulated funding platform. On the other hand, you don't want people taking their entire net worth. I mean, even sophisticated accredited angel investors shouldn't be putting more than 10% or so of their portfolio into this kind of stuff. And if you have total unfettered access and people see this as gambling or Vegas style stuff, it won't work. The whole purpose of my book and what we keep sort of preaching to angel investors is take this seriously. This is not gambling. I mean, if you think it's gambling, you shouldn't be doing this. This is not going to Las Vegas or Atlantic City. This is part of a legitimate alternative asset class. And if you do it right. It's going to take a long time. It's illiquid. Half the stuff is going to lose. It's a game of law of large numbers. So do it intelligently, and if you do it right with that kind of discipline, there's a very good chance that you'll make a fair amount of cash.
Well, that is a great point on which to end. Now tell us, where can people find your book, and how do they sign up as investors, or how do they sign up as entrepreneurs on Gust? Give us a quick rundown on how people connect with you.
It's really, really tough. Go to gust.com, gust.com. If you're a company and create your profile, it's free. Then you'll have access to all of these investors and stuff around the world. If you are an accredited investor, for now, we don't actually say individual investors come into Gust. So we now work with groups like angel investment groups and the like. So come on to Gust, find a group, join a group, and then you'll be on Gust. As for the book itself, it's a New York Times bestseller. It's available on Amazon, Barnes & Noble, your local Barnes & Noble retail store. If you don't see it there, ask them to get it for you, and I think you'll actually enjoy the book.
Fantastic. Well, again, David, thank you very much for being with us today.
My pleasure. Thank you.
All right. Let's do some good.